accounting design project. Very happy to be here today to present Steve Penman. I'm Daphne Hart from the University of Illinois at Chicago. I will be moderating the session today. So please, if you haven't done so yet, please mute yourself. If you have any questions or any comments you'd like to make during the session, please use the chat or the raise your hand function. I will draw Steve's attention to it if needed. And of course, as always, you're very welcome to turn on your cameras, your videos. That is, I tell this to my student, it helps with engagement. So if you can, please do so. So without further ado, Steve Penman will present his work on accrual cash flow relation and the evaluation of accrual accounting. Steve, the floor is yours.
Okay, thank you, Daphne, very much. And thank you, everyone, for joining us today. I think this counts as being aligned with the accounting design project because accrual accounting, of course, is at the heart of accounting. If we just keep a cash book, we just have a cash flow statement and one account on the balance sheet, the cash account. And accrual accounting, of course, expands the balance sheet and, of course, has a different flow number called accrual earnings. So it's at the heart of the of accounting. The paper here, and my co-author Hung Il Oh is at Korea University. I believe he's in the audience. Little concerned about this paper because I think it touches a nerve. It could be controversial, and I'm worried about treating this in the right way with the right tone. So please, if you have any advice on that, we very much appreciate it because it's critical of research endeavors in this area. Let's get going then. As Daphne said, anytime you have a question, put it in the chat box and she'll relay it to me, or a challenge, disagreement. Very interested to hear that. Okay, so there's been a long, of course, given the importance of accruals in accounting, it has been very much at the center of accounting research. And it's developed along a line that we're going to maintain in this paper that involves some misconceptions. And we want to point out that misconceptions constructively and how you might actually conduct the research a little bit differently. The seminal paper here is by Patty DeChow, which got the whole thing going. There's some very good aspects to that paper, but there was one thing that actually people picked up and that's the first to quote here: if accruals are used to smooth temporary fluctuation cash flows, then the cash flows and accruals will be negatively correlated. And that is what's called the accruals cash flow relation, a negative correlation between cash flows and accrual. And it's that relation that is at the heart of our critique here. Bushman, Lehman, and Zhang is a very widely sorted paper in JAR, which picks up on this. And they start off by saying the lead sentence: a fundamental property of accruals is to smooth out fluctuations in operating cash flows. So the idea is cash flows are more volatile and accruals smooth this out. They're a reaction to the cash flows. Negative relation between accruals and cash flows is necessary characteristic of high quality accruals. So this has become a life of its own. That this negative correlation is a characterization of quality accruals. So the higher the negative correlation, the higher the quality of the accruals. And there's another quote there from a more recent paper that I'll leave you to look at. Okay, so as you notice, I headed this Accounting 101 because really what I'm saying is, somewhat embarrassingly, is that really what we're saying is, let's think about our Accounting 101 and what is an accrual under Accounting 101. So with a little bit of a tease here, I'm going to give us all an exam. And I'm going to ask you all to put your answers into the chat box. No. Here's the cash flow statement for Microsoft for 2019. It's a standard cash flow statement where you start with net income and you get the difference between net income and cash from operations. And the question here on the first question is, where are the accruals? The research says the accruals are all these items between net income and cash flows from operations. They're the accruals. That is the basic point that we make in this paper. These are not the accruals. They are the changes in the balance sheet items. Okay. Now I've made a mistake myself. I've in class I put up a cash flow statement and said these items between cash flow from operation are they the accruals. Okay. I've done it many times in class, and I realized that this is a mistake. You'll notice in the cash flow statement they're not accruals. That's something we've nominated our research to call them accruals. The answer, of course, is the accruals are not in the cash flow statement. The numbers between cash flow from operations and net income are simply reconciliation plugs. They are the difference between accruals and cash flows. Okay? They explain the difference between accruals and cash flows. They're just a plug. They are largely, with the exception of depreciation and amortization and perhaps some other long-term accruals, they're simply the changes in the balance sheet items. So the accrual for the number, the plug number for revenues is a change in accounts receivable. But basic point is that that's not really the accruals. So class, we move on to this paper says, look, says it makes those 3 points, and then it says, as a result, this accruals cash flow relation is not a measure of the quality of accruals. And empirical research in accruals must be revised, and the paper starts to do so. So that's basically the content of the paper. So now, students, professors, I haven't taught the core course for the basic financial accounting course for a number of years, but I just want to go through our basic accounting 101. I've got some journal entries. This is the first paper I've ever written where I've got journal entries in the introduction or even in the paper. At our fancy business schools like Columbia, we're not supposed to teach journal entries to the MBAs. It's below their dignity. But I'm going to deal with journal entries the way I learned it, and most of you learned it, okay? So here's a question. There are 2 journal entries here. One is to record revenues. Debit accounts receivable, credit revenue. A, when the cash is paid, you debit cash, you credit accounts receivable. B, which is the accrual? A or A minus B? Where, of course, A minus B is what's in the cash flow statement. And I think if you know your accounting, you would have said A, not A minus B. A minus B is actually affected by the cash flows. In this case, we got a cash payment of the receivable of 40. But if we got a cash payable of receivable, so therefore A minus B is 60. But if in fact the customer had paid 60 in cash, then the accrual A minus B would be 40. That's not in a that's not an accrual. It depends on the cash flow. So there's the question: is the revenue accrual related to cash flow? No. One of the points of the paper: the accruals are independent of cash flow. So the idea of a accrual cash flow relation is not something, not an appropriate concept to think about the accruals. Is the accrual revenue related to cash flow? The answer is no. Under our accrual accounting, we book revenue when certain revenue recognition principles have been satisfied. We have a customer, the receipt of cash is highly certain, completed contracts, all that sort of thing. No reference to cash flow. Now, of course, it has implication for future cash flow, but we're talking here about the contemporaneous cash flow. It's independent of the cash flow of what the customer's paid off this period. Is A minus B relevant for booking revenue? No. You make the revenue accrual without consideration for the cash. Okay, so there are the answers. Let's think about expenses. The first journal entry is the expense to the journal entry to record cost of goods sold. When in fact the inventory is purchased, we debit inventory and credit cash. Which is the accrual, A or A minus B? Well, I hope you agree that it's A. And what the amount we spent on cash for inventory and the difference between A versus and B is not relevant for our cost of goods sold. We say, okay, no, we recognize the cost of goods sold, nothing to do with the cash paid for the inventory. We recognize that on the basis of the goods that were shipped out. So we match the cost of goods sold to the revenue to get a sense of the gross profit. And so that's the answer there. And that's so for all accrued expenses, okay? They're independent of the cash flows. You accrue the wages because you incur a liability for wages this period, nothing to do with the cash flow, whether you paid the wages or not. That just determines the balance sheet, the wages payable, and the changes in the wages payable given the cash. We accrue a pension liability, not on the basis of the cash, but on principles to record the service costs, etc., and the liability in the balance sheet based on accrual accounting, independent of whether you're paying the retirees or whether you're making contributions to your pension fund. It's completely independent of the cash. Now, this is Accounting 101. I hope no one disagrees with this. If you do, please tell me, because there's been something wrong in my basic education. A finance audience are much more difficult to get these points across. Okay, but it's gratifying here to talk to a bunch of, I presume, mainly accounting professors. So here's the lessons learned here from our Accounting 101 class. The cash flow numbers are just plugs. They are the differences between cash flows and accruals, which they're supposed to be. Explain the difference between cash flow and accruals. Well, it's in terms of the balance sheet, and the balance sheet item is the accrual minus for the cash flow. The change in the receivable is the receivables you booked, okay, adjusted for opening balance, receivables you book adjusted for any cash flows during the period. And so that measure is a mixture of cash flows and accruals. But that is the measure that was typically used in the accounting research. Accruals determine earnings, cash flows do not. Accruals and earnings are independent of the cash flows. The cash flows are irrelevant. If anyone could give me an example where that's not the case, please do. Okay.
Dave, we have a question.
Sure, go ahead.
All right.
Mike.
We have a paper where we tried to measure accruals in a manner that captures the accruals in a comprehensive and mutually exclusive way. We defined accruals as being any change in non-cash assets or liabilities. This is different than what you're doing here. I'm not quite sure how it compares.
Well, Mike, I think you're making the same definition of accruals that's standard in the literature. The change in the accounts receivable, okay?
Right.
The changes in the accounts payable or the accrued expense liability or the pension liability. But that's and that's the standard. But that is not the accrual that goes into the income statement. That is includes cash flows. The change in accounts receivable is the accrual minus any cash you paid off. Okay, so it has the cash. I understand people say well, that's not the way we define it. Okay,
right.
Of course, you're entitled to define it any way you like,
Yeah.
Provided you get traction in where you're going. Okay,
right.
The point here is, first of all, yes, you can define it the way you like, but let's think how accounting works. Okay, let's define it as you define it in a CPA exam. Okay, to pass a CPA exam, and the point of the paper is having the incorrect definition of accruals means then you proceed on the research to look at the relation between accruals and prices and the quality of accruals based on the wrong notion of accruals, which then you're addressing to accounting, which really teach accruals differently. So that's the point. Now, this paper was rejected firmly from the accounting review, and the basic review comment says that's not the way we define accruals. The tradition in accounting is to define it the way you are defining it. Okay,
Right.
but this is actually this is actually the point of the paper. That is not how accounting works.
But
the revenue accrual has nothing to do with the cash flow. The change in receivable does.
Yes, I think that my understanding of accrual is exactly that. That it's the revenue less the collections.
Well, if you as I say, you can define anything any way you want, but then the question of how you run with that and what the inferences you make. But please, please, so you may be looking at something else, but please don't bring it back in terms of talking about the accruals that are in accounting. Okay, the revenue accrual. You may be running with something else, okay? And it may be, and I think there are issues for which the difference between accruals and cash flows is going to be issue. In fact, we have one in the paper, okay? This whole stream, however, is started to talk about the quality of the accruals based upon that notion, okay? But that definition, which actually leads you up the wrong creek. And the inferences are then from the research, which is a long research. I mean, there are many, many papers in the stream of research who have taken your definition or the common definition of accruals.
Well, let me ask it differently, and then I'll shut up.
Yep. No, sure. Go.
How is earnings different from accruals in your setup?
Earnings are no different from accruals. Accruals determine earnings, and accrual counting determines earnings. Okay.
Okay.
And the cash flows are irrelevant. Now we'll bring data to that. We'll bring, I think we've just shown the journal entries that. Can you think of accrual which is a response for the cash flow? You actually debit the accrual, credit the difference based on observing the cash flows. I can't think of the journal entry. All my journal entries are independent of the cash flows. For cost of goods sold, for accrued expenses, accrued insurance, accrued rent, it's all independent of whether you paid the rent or not. Okay.
I think we have more questions. So
go ahead, please. This is important for us to get this straight, because if I'm wrong, if we're wrong here, man, I'm going to learn something.
So let's start with Yung. Do you want to start? You have a question?
Yeah, I have a clarifying question and also a follow-up. So the clarifying question is, I think I hear you, is that there are potentially two measurement systems. One is based on cash accounting all the numbers we recognize in the income statements, in the balance sheet, the level of dollar amount is accrual, right? I think that's kind of like how I interpret the paper and what you just defined accruals rather than just changes. So bringing that kind of back to research design is that instead of kind of like decompose earnings into these two components, would you recommend us just have a accrual number, for example, earnings as a regressor plus a cash flow? So we are going to put numbers recorded under the accrual accounting system. Plus there's another number based on the cash accounting, instead of kind of like putting the two as a decomposition and normalize to 100%, which doesn't really make sense because those two numbers coming from two different systems.
You'll see those regressions, okay? Yeah. Where these are separated out. In fact, that's That's the separating out the cash flows from the accruals at the heart of it. And you can't treat the difference between accruals and cash flows as the relevant variable. You'll see those regressions. Okay. By the way, one argument is to look at the difference between looking at the changes in the balance sheet is that you might want to think about changes in the balance sheet. And first of all, you have to think about accruals. Some people say, well, I want to look at this because I want to think about the added information, okay, from having accrual accounting versus cash flows. And so there I want to use A minus B, okay? But in my mind, that's a suspect endeavor too, because the cash flows that you observe now in the system really is conditional on having conservative accounting, okay? So do you think your payments for your payables would be the same if you didn't keep track of accounts repayables? Or you get your cash receipts would be the same if you didn't keep track of your receivables? And so you never observe what the cash would be if you didn't have accrual accounting. So I think that that's one reason you might want to do that. But that endeavor, in my mind, also is doubtful, given that you cannot observe what the cash flows would be in accounting where you did not have the accruals. Anyway, we'll get on, but you'll see those, and you'll see those regressions. Okay.
So I have a follow-up. Is that I think a lot of researchers use cash flow is that we are looking for something unbiased, fundamental numbers, right? Like I think in the accrual accounting numbers, people were concerned about their like frictions in terms of accounting standards or managerial opportunistic behaviors somehow create some biases in this accrual accounting system mapping with business fundamentals. So I think DeChav say that's just assume a cash flow is unbiased measure of business fundamentals, and then that's why we are going to actually compare that or use that as a benchmark to judge the quality of earnings. It's a little kind of deviating from your current paper, but like how do you view the cash flow as fundamentals or intrinsic current value? Yeah.
You're quite right, and that's the last table in the paper. There's nothing wrong with looking at cash flows for the quality of the accruals, okay? So we teach that, I teach it. If in fact the accruals are high, but the cash flows are low, you might want to look and see what the quality of those accruals are like, okay? And that's in the last table of the paper. But you know, the standard research says a negative correlation between cash flows and accruals is accrual quality, okay? Where that says, hey, it goes the other way. There's a lot of difference between the accruals and the cash flows. Yeah. Then that's the challenge to the quality. So it goes exactly the other way when you're looking at cash flows as a basic metric to judge the quality of the accruals. Okay, the quality is that you get a positive correlation. Quality accruals, there's a positive correlation between accruals and cash flow, where they say the negative correlation is quality accruals. You see, so but by the way, cash flows can be manipulated also. Okay, very much. Okay, so here we'll do this a little more formally. And what I'm going to use in this presentation, when you see accruals in red, this is the accruals as measured in the research, the changes in the balance sheet, okay? So this is the way it's usually set up, but the papers usually start with this. Earnings is cash flow from operations plus accruals, okay? And of course, that comes straight from the cash flow statement. And defining accruals as the difference between cash flow from operations and accruals, that statement it's an accounting, it's a correct statement, no problem with it. Okay. So therefore, revenue is the cash received minus the changes in accounts receivable. Under that definition of accruals. And this is the definition in the literature. However, the way the accounting works is you have cash flow from operations. This accruals in red is the actual accruals in blue minus the cash flows. Okay, that is the number in the cash flow statement. And when I went to school, you ran that through. That equals earnings. So when you have the accruals affect the income statement, you run that same equation through. If this is just accruals minus cash flows, the change in the balance sheet, well, then what you're doing is actually cash flow plus those accruals is actually equal to earnings. That is, as we said before, it's accruals that affect the accrual accounting that determines the income statement. Okay. And so for expenses. It's accruals in the blue, which are the actual accruals in our journal entries, and I think in Accounting 101 that determine the income statement. If anyone can think of a case where the accrual recorded is made with reference to the cash flows, okay? That is, if I have a very low cash flow, I record more accruals, okay? Which is the accruals cash flow relation. Well, then I really want, I've looked for this and I cannot find it. Okay. The critique here is that accrual quality is not exhibited by the negative correlation between accruals and cash flows. The quality measure in the literature is a correlation between cash flows from operation and accruals, okay? But accruals are the difference between cash flows from operations, accruals and cash flows. So this quality measure is generated by the amount of cash flows you get. The change in receivable, accounts receivable, is determined by the amount of cash they paid off each period. So this measure, it's actually by construction, it's generated by the cash flow given the accruals, because accruals are actually the cash flow from operations minus real accruals. The red accruals are the blue accruals minus the cash flow from operations. So this correlation is not a correlation between accruals and cash flows. It's a correlation that's induced by including cash flows in the measure. It is mechanical. It's by construction. So taking this measure as a measure of accrual quality, where it actually is driven by the amount of cash flows, is spurious.
Can we take a couple of questions?
Yeah, please do. That's, yep.
Jeremiah, would you like to?
Oh, thanks. No, I agree with the other comments that have already been made. Thanks.
Oh, okay, very good. Okay. So let's see. Oliver, would you like to comment? I cannot hear you. Maybe it's
mute.
Sorry. Sorry, I think Steve, can you hear me now?
Okay, you got your Oliver, yeah.
Yeah, I was just wondering about the dynamic aspects of the relation, but I think you cleared it up, Steve, when you made that statement on the slide that accruals are independent from cash flows. I think you're talking about the in the period relation, right, rather than the dynamic relation, because, for example, if I have a accounts receivable, then I'm probably more likely to collect cash in the future than not.
Oh, most definitely, Oliver. We're talking about the contemporaneous cash flows here. Quality accruals would be those that would actually forecast the future cash flows, okay? The idea of accrual accounting is to give you an indication of the cash flows you're going to get, okay? So the pension accrual in principle should be telling you about the cash flows that are going to be paid out on pensions in the future, okay? So most certainly, this is this. I should have been clear on this. This is the contemporaneous cash flows. Okay.
I think there's one. Sorry, no. If Jonathan, would you like to ask?
I don't have a question. I was just trying to move things along. Kim.
Oh, okay. Okay, so I'm just trying to draw the attention to what's going on. Okay, sorry. Go ahead.
Clear? Okay, good. Okay. So the hypotheses are misconceived, and that's a very severe criticism, because misconception is one of our worst sins in a sense in research. But as I say, I've made the mistake many times myself. Okay. And I don't want this to be particularly negative. We all struggle on research. We try to deal with abstractions. We try to deal with it. So this is the people involved in this research have been very capable researchers. But there is a misconception. I think that misconception needs to be pointed out. So the idea is to define accrual quality by this correlation between accruals and cash flows. And a lot of the papers saying, well, look, it seems like there's been a decline in the quality of accounting over time with lower R-squareds on returns and so on. And they try and attribute this to a lower negative correlation. That's the Bushman et al. Paper in JAR. That actually there's been a decreasing negative correlation. And that's the reason why we see accruals being less informative. But the point here is that metric is just totally spurious. It won't uncover the quality of the accrual accounting over time, or earnings measurement. And the other aspect is that the higher the volatility of the cash flows, the more accruals are going to be more important because they adjust the cash flows. Okay, so when cash flows are down, we have higher accruals. When cash flows are up, we have lower accruals. They smooth out this volatility. And accruals are of high quality when the distance between cash flows and accruals in red are large. And so we test these hypotheses.
Question from Youngjae. Sorry.
Hi, Stefan. I have a question. Yes, this question is related to the concept of accruals again. So, let's think about, the company made a $100 sales, but they sold $60 on credit and $40, for cash, right? So how much is the accruals there?
The total revenues, $100.
I would say that, when I teach the accounting to the students, I say that, that's $60 because, you sold 40, you sold 40 for cash. So that's the cash sales. Yes. And then, you accrue $60 in the accounts receivables for the $60 sales that you made. And then, so the reason that why we, kind of calculate the accruals, that's the difference between the earnings and cash flows, is because we want to only account for the $60 of the sales on credit. And then that's why, the higher accruals means lower quality because you sold more, products on credit than for cash.
I think you're wrong. That is not the journal entry. Debit accounts receivable, credit revenue for 60. The accounts receivable, the journal entry, which is the first one on my journal entries, which you recognize revenue 100, accounts receivable 100, and the cash is just then to pay off the accounts receivable. The change in accounts receivable is not recorded by recording the difference between the cash flow and the accruals. It's recorded by recording the accrual, the revenue, which is independent of the cash flow. That revenue, 100, would be the same if, in fact, you had 0 cash flows, you had 100 cash flows, or you had 200 in cash flows.
But you are thinking about only the case where you sold the entire thing on credit at first. So you accrue the accounts receivables for the 100, and then collect cash for 40. But I'm talking about the case where you sold the 60 on credit and then 40 for cash.
But the credit side of the entry, we're talking about the accruals affect revenue, would still be 100 if it went to cash or it went to accounts receivable.
Yeah, total revenue will be 100, but
independent of whether it's in cash or cash or a credit sale.
Yes, of course.
Well, that's the point then.
Yeah, but when you kind of have an expense for cash, would you say that's the accrued expense?
Sorry, no, accrued expense is always non-cash, right?
Yeah, so kind of that's the concept of accruals in accounting, I believe.
Well,
Yep. Yeah, I think I try to kind of reconcile like the argument between you two is that I think Youngjae is that think about a company's transactions. Some of the transactions actually just happen during a single period, for example, cash sales. some transaction can across multiple reporting periods, for example, credit sales. And that is true regardless what accounting measurement systems a company adopts. And then before we see all those realized transactions come in, we have two options. One is cash accounting, that we only book or record anything in our system whenever there's a cash receipts or payments. The other one is accrued accounting, that based on the accrued accounting principles, regardless whether it's a cash transaction or credit transaction. I think Steve's point is that regardless, in realization, we are going to actually make a cash sales or credit sales ex ante. We are going to have a accrued accounting versus a cash accounting principle or measurement system in place, and we are going to follow that principle, and then to kind of like record those subsequent realized transactions. And that's kind of like the difference or distinction between your point in terms of the nature of the transaction versus Steve's point is the nature or the principle of the measurement system. I don't know whether it helps, but I feel like you are talking about two different.
I actually agree with you. Yeah.
Yeah, I mean, I think my point is, if you've recognized $100 of revenue, it doesn't matter where you got the $100 in cash this period, you got it next period, or actually you got it the previous period where it would have become deferred revenue. Okay. So it's completely independent of when the cash is received, whether it's 40 or 60 or 60 or 40 or it's 100 or 0. That's how the system works. Okay, so then the thing is that this negative correlation is the higher the negative correlation, the more the quality of the accruals. But this picks up on Young's point earlier, that actually when the accruals are far away from the cash flows, then we deem them to be poor quality accruals. Okay, and we'll see the results there. It goes in actually the opposite direction. If you have a lot of receivable, you have a lot of revenue booked, but no cash flows, you say, gee, maybe they're fiddling around with the revenue accrual. Let me go and look at that. So the negative correlation between accruals and cash flows means lower quality accruals, not higher quality accruals. At least that's what I teach in financial statement analysis, and that was what I think A. Young was alluding to at the beginning of the seminar. Okay, so now let me just get a more formal setup for you. Okay, so this is an accounting system, an accounting system, and really it's our accounting system, which separates accruals from cash flows, and it's set up by a series of accounting equations. It's an accounting equation where the book value of equity separates the net operating assets in the business and the net debt. Okay, so the book value of equity is just the assets in the business minus the net debt. And therefore, the change in book value is just the change in the assets minus the change in the debt. These are just balance sheet equations. Introduce the clean surplus equation for operating activities. The change in net operating assets is operating income minus free cash flow. Now, that's just an accounting equation. The change in net debt is the net financial expense or the net interest you recognize minus the free cash flow plus the dividend. Another accounting equation. That is, you accrue the net debt, the amount of interest you owe, you actually reduce it by any free cash flow that's left over after paying your dividends. So now let's put this expression with these two components in it, and you'll see that change in book value is operating income minus free cash flow minus the net financial expense, the change in the net debt. And what do we see? Well, the free cash flow drops out. The cash flows drop out. And you get the basic clean surplus equation for the book value. It's operating income minus the net interest expense minus the dividends, which is earnings minus dividend. And so the remarkable thing about the accounting system, if you really study it, how it works under the accounting equations, it just doesn't say accruals are added to cash flows. Accruals are different cash flows. It actually says cash flows are irrelevant. They drop out. Now, that's quite remarkable, actually. and actually it accords with our economics. Under M&M, cash flows are irrelevant. The fact that you paid your employees retirement pensions this period is irrelevant. Okay, it's irrelevant for liquidity, but cash flows are just irrelevant to valuations, and the accounting system remarkably includes that that property. So it's actually built into the accounting system, and of course, this operating income or these earnings are the result of the accruals. And I can substitute accruals for earnings here. Okay, so now we go to the data. I think I've got the basic points across. All I'm doing is accounting 101, okay? All I'm doing is accounting 101. With a little bit of formality here that shows you that actually built into the systems, the free cash flows are irrelevant to the change in the book value of the equity or to the earnings. Now we have a data, period data going from 63 to 2016. Usual thing, a few firms excluded from some odd numbers, but basically we've got every US listed firm. Okay. And the first regression I'm going to put up, which is one that A. Young was asking for. Well, does the market price? Does the market price the accounting as if the free cash flows are irrelevant? And so what I've got here, it's actually from the Penman Yehuda paper, which runs this through 2013. What I've got is here a standard, capital markets regression. Okay. I've got, where's my cursor? I can't, there he is. I've just got price changes. These are equity price changes on the left-hand side because I've moved dividends to the right-hand side just in case they have some information content because they're a cash flow, okay? And I've got the earnings and I've got the free cash flow. Do this every year. Look, get the mean coefficients relative to their estimated standard errors every year, T statistics. Count the number of times you see a positive every year over the 50 odd years. And this is what you get. Well, usual things, 1.3 on earnings, a negative on dividends because that's the M&M property that dividends reduce prices, okay? That's the dividend displacement property. But there's the coefficient on free cash flows. It's actually zero. It's robustly zero, okay? And it's only positive 55% of the time in the cross section. So there's sort of the validation. You've got to have book value in here, of course, because you've got book value as bottom line number of the income statement. So if you want to understand this full specification, you can go back to this Penman Yehuda paper. But there you have it, that actually in the accrual accounting system, free cash flows drop out as irrelevant, and that's how the market actually prices it. It prices accrual earnings with a multiple, 1.3, but it treats free cash flows as irrelevant. Okay, so that's the answer to the first question. Now, we understand from our accounting equation that change in the net operating assets is equal to operating income minus the free cash flow, which is minus the cash flow. Free cash flow is cash flow minus the cash investment. So it's minus cash plus the investment. Does the market price cash flow from operations as a negative? Just like it's treated in accounting. In accounting, cash flows reduce the net operating assets. You see that in your receivable. If you get cash, you reduce your receivable and you increase your cash. It reduces your asset in the business. That's just, again, the accounting. That's accounting journal entry number B. So the answer there is yes, too. So now what I've got here now is, because I'm looking at the business operations, I've got the price, enterprise price changes, the price of the net operating assets on the left-hand side. I have the operating income, which is determined by the accrual accounting. And I've got the cash flow from operations and the cash investment. Now there's your coefficient, positive, robustly positive on the operating income. The market price is accrual accounting, accrual operating income. You got 1.33 on your investment, which is really quite interesting because in a start, typically these investments are treated historical costs, but the market actually prices at 33 cents per more on average positive NPV. Okay. But the remarkable thing here is, and when we got this, I had to go back. Let's just check out our coding here. The remarkable thing is, well, the coefficient on cash flow from operations is not -1. I'm sorry, it's minus 0.99. The market prices cash flow from operations as reducing the value of the operations, the pricing of the operations. And when you think of that, makes sense. When I get cash, I reduce my receivable, reducing the assets in the operations, and I go and invest it in cash and cash equivalents or a T-bill. Investing in T-bills doesn't add value, okay? I put it in an asset that doesn't add value. So I reduce the value of operations. I add to my cash. It's just 1-to-1. And so there I get the negative on the cash flow from operations. And that's M&M. Cash flows are relevant to valuation, but they displace prices 1-to-1 under the dividend displacement property, they call it. But this, of course, is the cash flow that's coming from the business. It's the dividend from the business. Now, so they're the regressions, which are an answer to a Young's question, and then that sets us up for the specification by which we're going to look at the issues that are raised in the accounting research under this idea, under the standard definition of accruals. Daphne, you got a question?
Yeah, before we move, I think you have another question.
Yeah, so I think Jonathan Glover previous talk about, like, we agree with you that the external literature may misdefine the accrual accounting system, but I think for the paper to be kind of closer to publication, that you probably need to tell the literature that what's the implications of this misconcept. So two things I have in mind, and one related to what Yang Tae previously asked, is that is there any prior empirical evidence that after adopting the new concept or correct way of definition, we would find actually different empirical results, or we would actually have a different interpretation or inferences based on the same set of empirical results? For example, we would not say certain results indicates higher or lower quality, but actually the implications will be stated in a different way. So how do you think about that, correcting this misconcept will actually move our literature forward in terms of how we learn from the studies before this piece?
Well, that is actually, in answer to your question, I don't know of any paper that's actually done the research has actually, I think, been bogged in this misconception. I don't know any other paper that's sorted out. But that is, of course, the rest of this paper. We sort out, we go and look at the hypothesis tested under the appropriate definition of accruals to see whether the results they got with the misconception survive with the right characterization of accruals. Okay. Now there are some papers. There's a theory paper, Valerie at Chicago. It's a theory paper which actually has it right. Okay, it's a theory paper that has it right. Unfortunately, when he goes to his empirical work, he falls back into the traditional definition of accruals. Okay, so in his theory, he actually, it's referenced in the paper. Excuse me. He has it right, but when he goes into the empirical work, he adopts the standard definition of accruals in the research. I don't know of any paper that actually has sorted it out. If they had this, we wouldn't have this paper. Okay, but having said that, the rest of the paper is entirely to your question.
But I think my suggestion is that how about replicate that Valerie 2018 paper using the correct way of definition to see how the results would look differently, because I feel like
you can go that way if you want. That's not my aim to focus on that one particular paper, but I think except to point out that it needs to be adjusted for the, and if it did, given the theory gets some results, then you'd probably get a justification of the theory if you did it. Okay, but that's not what we want to do.
We have another question from Jonathan.
Hi, Stephen. Just a quick clarification question on the last empirical observation, the -1 coefficient on operations. Is that, to what extent is that definitional, in the sense that, you have the price of the firm, and then you subtract away the price of enterprise value, and you're left with the debt, the net debt. So I mean, to what extent is this just a mechanical observation versus something more?
No, it's not a mechanical observation. I could take this and put it over here because I think about the cum dividend return. Okay, so I could put it over here. I want to put it over here, so I want to test it. Okay, putting it over here just says I see the displacement property. I don't see anything that's just by construction.
But how do you come up with price of net operating assets? Isn't it, the value of equity minus, adjusted for the net financial asset?
Correct. That's right. That's correct. So here's the pricing of the operations.
If I move cash from operations take it out of operations and put it in, take it out of receivables and put it in cash, isn't it mechanically just moving over to the net financial asset?
That's correct. And that's what the accounting does. And the accounting says it reduces the book value of the net operating assets by $1 and decreases the net debt by $1. Okay. That is, in fact, that equation there, the bottom equation there. Okay. All it does is reduce the receivable by $1 and reduces the debt by $1. And so it doesn't change the book value of the equity. And so what we're saying here is that let's see if that is the way the market prices it. Now, if in fact, just as this happens with the equity, the dividends reduce price dollar for dollar under M&M, we then come along and say, oh, hold it, dividends can be signals. And so it may not be that case. It may not be that. It'll have a different coefficient. And what we're saying is, well, maybe cash flow is a signal here, and it's going to have a coefficient different from -1. But the actual pricing says, no, it's not. It just works as actually, if you take $1 out of the business and you put it into cash, it reduces the value of the business by $1. It's not a signal. It gets another multiplier.
Got it.
Yep. Yep. Okay, so
sorry,
go ahead.
Christina? Oh, you're on mute.
So here it is. Does it matter where in which stage is the company when we measure that? In the sense that, is it at the time when accruals are originated, so you have a lot of origination of accruals, or are we capturing this observation of the time when the accruals, are reversing? I don't know. Does it matter whether the accruals are in a different stage of life?
No, we're not looking at over time at all. We're looking at in a particular period, I book the accruals and I have cash flows. Okay.
Yeah. Okay.
That's all we're doing. Yeah. Review accruals should reverse in the sense that you have a receivable, you should get cash in the future and reduce the receivable. Yeah. Of course, you get another period and you're all over, so you may get more accruals. Okay. So the receivables can build up because you've got a multi-period situation. But we're all within one period here, as is the literature.
Period. I mean, there is a paper which allows, identifying, origination of accruals, observations with a lot of originating accruals. So just a suggestion, you could try that to see how the coefficients, balance. Second question.
Sorry, Christina. A lot of what in accruals? Homogeneity?
No, homogeneity, origination of accruals.
Origination.
Yes, I can send you that later.
Okay.
And then, the second question I have, could you give us some context on the results that you have across time, the coefficients across time? They look quite interesting.
Across
years.
Well, across years, these coefficients here, all I can tell you here is that these are 100% positive and these are 50% positive and negative, okay, at the moment. So there's variation over time. Whether that in fact changes over time, yes, I can tell you that, okay. And that has to do with whether in fact accruals are priced differently over time and the information content of accruals has declined or increased over time, okay. That's pertinent to that issue. That's not this paper here, but the prevalent thing is the pricing of the operating income over time, okay. Not the negative accruals cash flow relation. So, but that's a paper for another day. Okay, so there are the questions, so this is what the rest of the paper does. We got three minutes, and so I'm just going to tell you what happens. Okay, if you want this full presentation, send me an email. I'll send it on to you. Of course, it's just tables from here on, and all the tables in the payment are in the paper. Is the pricing of accruals, that coefficient on the operating income, is that affected by the correlation between accounting and cash flows? No. Participate on that correlation, it has nothing to do with it. And actually, the coefficient on the C also has nothing to do with it. Reliably, always negative, okay? So the way you price the accruals in the operating income does not depend upon that correlation or the extent of the negative correlation. Is it affected by the volatility of cash flows? No, independent of the volatility of cash flows. Does the price of accruals depend on the length of the operating cycle? Now that's been tested and they show yes, and actually yes, okay, when you have the appropriate measure of accruals. So they actually get the right answer there, but with the wrong metric. Is the pricing accruals different for short-term and long-term accruals? Yes. Okay. And so with respect to those two issues, the results are supported. But now, as a Young was asking for, when you do it properly, do you get different results? And here are the comparisons. Then the last one is the one that I referred to. Is the pricing of accruals at all related to the difference between accruals and cash flows? And the answer is yes, but in a different direction from a negative correlation. And that's the financial statement analysis idea where you test the equality of the accruals by reference to the cash flow, the fundamentals, so-called, okay? If accruals are very high relative to cash flows, then accruals are priced lower. The market gives it a discount because of the quality of the accruals. And that's whether it's higher or extreme lower, okay? And so it goes in the other direction. When in fact, the difference between accruals and cash flow is large, positive or negative, the market discounts the accruals as lower quality, not higher quality. And that's, of course, what we do in our quality analysis in our earnings quality classes. So they're the results in the rest of the paper. The time has gone here. These are the results in the rest of the paper. Is a series of tables which are all in the paper. But if you want this this presentation, please send me an email. So my duty is that I want to announce that our next forum is 2 weeks from today, February 17th. Andrew Jackson from the University of New South Wales. Please, if you're interested, please dial in for that one, or register for that one. Please note the change in time for the obvious reasons that there's quite a bit of time difference between Australia and the East Coast. Okay. I don't know what that does to people in Europe, but it's 4 p.m. here. Christina, you're going to have a late night if you sign up. And Oliver. Okay, so thank you very much for your attention. if you've got any comments, will you please send me? Young usually sends on the chat box to the speakers. You know, as I said at the beginning, one thing we're concerned about is just the tone of this. Obviously, it's got to be critical, but we want a good tone. And so the tone of the writing of the piece is very important to me, actually, that it's written constructively. Thank you all for your participation and for your very good comments.
Great. Thank you, Steve, and thank you, everyone.